This is Taking Stock on Bloomberg. I'm Pimm Fox. We're talking about today's market action and also what this market action means for the future. My guest, Bob Prechter, President and Chief Executive of Elliot Wave International. Bob Prechter has long been bearish. Indeed, followers of Elliot Wave International theory, they have been basically sitting in cash, Bob Prechter, waiting for your signal to start buying. All right, tell us, what should we be anticipating in the future?
Well, the market did look attractive a year ago, but this is a whole other ballgame. What I'd like to do is show you a picture of the U.S. dollar going back to the low last fall. If we could put that up, because this is such an interesting pattern, and not only that, it's been a terrific ride. When you and I were talking last fall, I said the only market that I like, that I'm really bullish on, is the dollar, because everyone hates it so badly. We had the most negative readings I have seen. As you can see, only 3% of the traders polled by TradersFutures.com were bullish at that time. And it started a beautiful structure under our Elliott Wave model. If you look at our numbers there, you can see a 5-wave advance. Now that's telling us that the long-term trend in the dollar, despite everybody's distaste for it, is up. Now here's what's interesting. When it completed that 5-wave structure in June, I went on to one of your competitive stations, which we won't mention, and said this is a peak because it's a perfect 5-wave structure under the Elliott Wave model. We're going to have a correction for a while. It's probably better to be in the Swiss franc for a while. Now look at that tremendous 20% move all the way from 74 up to 88. But here's what's exciting. Last Friday, the dollar index retraced all the way back to the 80 level, which is exactly where it was at that little Wave 2 subdivision. That's one of the buying points in the Elliott Wave model. Generally, when you get an extended first wave, we're getting into technical analysis 201 here. But look at the supporting evidence. We had only 6% bulls last week in the very same poll. So people loved it at the top. They've hated it last week. And the perfect timing to send this out. I sent this picture out yesterday when everyone was saying, oh, the Fed has decided to inflate some more, so we don't like the dollar. And they also bought the stock market and pushed the futures all the way back up to 1124 on the S&P. And the next picture we're going to look at is the Dow Industrial Average. You see the flip side of this bullish picture in the dollar.
So this is a situation where people are deciding they don't want to take very much risk, and indeed what? They want to buy the U.S. dollar because it's a safe haven, or indeed because that's what they're going to use to buy U.S. Treasuries?
Well, my view is a little bit different. I think market causality comes from waves of optimism and pessimism. When the wave of optimism in the stock market peaked out earlier this week, what it meant was that people were also creating a lot more credit in dollar terms, and that brought the dollar down. What's happening now is we're beginning a swing toward more pessimism. That's going to bring stock prices lower and the dollar higher. Now let's look at this pattern in the Dow Industrial Average because this is very exciting. We had a top in April, and we came down in a pretty clear 5-wave structure, defining the new trend as down. And we've had an upward pattern where you can see we've labeled it A, B, and C, showing that it's 3 waves. Now, in some instances, that little B wave in a correction will make a slight lower low. Guess when the last time a picture looked exactly like this was? It was between August 25th and October the 2nd of 1987. So that's another reason I said now's the time yesterday to tell people that we're having a very similar setup. That doesn't mean the market has to crash, but it does mean keep your cash cool. It's not time to be long. The market needs another leg down.
Another leg down. Bob Prechter, when you look at the market action, if it doesn't correlate directly to the Elliott Wave theory in terms of the movement, do you then change the duration a little bit? Do you kind of step back with the perspective and indeed sort of look that maybe it's going to work, but it just needs more time in order for the thesis to play out?
Yeah, a perfect example is this summer. If you look at that chart we just had up there, you'll see the market had a very sharp rally going into June. That was enough of a retracement for a correction, and we thought, oh, that's about it, you know. And it came down, made its lower low there in early July, and then has spent all these weeks crawling back up to where it was in June, just essentially making a double top. Intraday, the S&P didn't even make a new high. The Dow did, so you kind of got this double top situation. That happens fairly often, so we have to be patient and wait for these things to work out. But I didn't send any kind of special bulletin until yesterday because We had this beautiful pattern, very similar to the top in 87, declining volume throughout the last couple of weeks during the rally. The perfect technical setup for another decline. So it was a good opportunity, if you're a short seller, to jump aboard.
All right, and still
today was a pretty exciting day.
And exciting also would be to be bullish the U.S. dollar right now. Does that have any
Very
correlation to what's going on with gold? We saw that gold pulling back below $1,200 an ounce.
Yeah, definitely, because if we've started another period of concern, and that means a harnessing of that deflationary power, which is going to create less credit than there has been inflated over the last few months.
That's that wave of that's the wave of pessimism that you're describing, right, Bob?
Right. And most people think that means, oh, gold is going to go up, oil is going to go up. Wrong. If you look at today, the dollar jumped, and gold and silver especially went down. Oil went down. This is a classic. People who are invested in the financial markets in a deflationary wave are going to see those prices fall. So this is why I've been safety conscious, 100% cash. Our buying opportunities in stocks, in commodities, in real estate, and even foreign currencies lie ahead of today. Let's get through the bear market before we put any of that cash to work. All
right, and right now just sit in cash, and in a sense, if you're in cash, you're already long the U.S. dollar, right?
That's exactly right. If you were in the Swiss franc for a while, you've gotten back in the dollar. Just sit tight. At least that's what my people are doing. Now, if you're really aggressive and you follow the short-term waves on our short-term update, you might want to be a short seller. I think a lot of people did that yesterday. But we're watching very carefully to make sure we're on the right track. And anything that took the market back above recent highs would be a problem for our current outlook. So
I want to thank you very much, Bob Prechter, coming to us from Elliot Wave International. He's bullish the greenback.